Good morning, everyone. That is if you're in the West African time zone, and good day if you're joining us from elsewhere around the world. My name is Shego Adams, and I'll be your host for today's webinar. Okay, so I can see that we're having some more people join the call. I would just crave your indulgence to give 30 minutes for us to comment, so we have more people join and we start at the same time. Sorry, I meant 30 seconds. 30 seconds. Apologies. All right. Good morning once again and good day to you. Welcome to the H1 2025 review and H2 outlook session by Afrinvest Research. As the title suggests, that is beyond silver lining, statistical gains, social strengths. We are going to be looking beyond headline numbers today to understand what the drivers or factors behind trends we saw in H1 are, how we expect them to evolve in H2, what you should expect as investors, business people, and even citizens, and at the same time, how this affects you, your investment wealth, and your journey. So to do that, we have put together our team of expert analysts, which I'm very excited to share with you. But before I introduce our panelists, I would just like to lay some ground rules very quickly so that we can maximize the meeting today. The important one, as you might have noticed, is that participants are in listen-only mode, and it is deliberate so that because we value your time and want to minimize distractions, we are going to leave this conversation just in listen-only mode throughout the presentation. However, we have opened the chat for questions, inquiries, and we are happy to receive questions during the course of the presentation. We'll just urge participants to keep conversations in the chat room on topic and also be respectful in the engagement with other participants. So without much ado, I'll just quickly introduce our participants today. To begin with, we have Ibukun Luwajala, who is our in-house global economy and market expert. The first half of the year has been very topsy-turvy. We had a lot of turbulence, but her steady hands, insights, and expertise in geopolitics, in commodities markets, in the global economy is going to provide some insights into what to expect as we have already begun the second half of the year. Immediately, we'll bring it home, and we have Governor Janaku, who is going to help us understand the local context and how all of this translates to our expectations for the Nigerian economy. And we'll move to the markets also. We have Ikeoluwa Debowale. She's going to tell you where the money is at. She's going to give you that investment advice that can make your 2025 very amazing. And last but not least, Prosper Olushola is going to then wrap it up for us and help us navigate the yield environment, given the complexities we're seeing today on the global and the local level. So once again, I want to thank you so much for your time. And I want to assure you that our team of experts today that are enthusiastic, and we've done our research and we are happy to share them with you. So without much ado, I will bring up the first speaker to commence the presentation. Thank you very much. Okay. So let me hand over to Ifeoluwa for presentation.
All right. Thank you, Shegun. Good morning, everyone. I'll be walking us through the global macroeconomic environment in the first half of 2025, and I'll also give an outlook for the second half of the year. I'll explore key global trends across inflation dynamics, monetary policy, GDP performance, geopolitical landscape, and market development. So, starting with inflation, so far in the first half of 2025, we've seen inflation continue to ease globally, and this has been largely supported by tighter monetary policies, falling commodity prices, and improved supply chains. So as a result, the global inflation rate, which was about 5.7% in 2024, has continued its downward trend this year. However, most advanced economies are still struggling to bring inflation all the way down to their 2% target. And that's because the main risks have shifted. They are no longer just about high demand or loose monetary policy. It's now deeper structural issues like geopolitical tensions, energy price shocks, and global trade disruptions, which are playing a bigger role. Then for monetary policy, uh, in the first half of 2025, most of the central banks we tracked started easing their monetary policies. Many of them cut interest rates, responding to slowing inflation and softer economic data. But despite these cuts, central banks have remained cautious. They flagged a few key concerns. That's the delayed impact of earlier rate hikes, especially on consumers and businesses, ongoing geopolitical risk, and the fact that inflation is still above targets in several regions. Therefore, global growth, because of the continued US trade rift with other major economies, the IMF cut its 2025 global growth forecast by 0.5 percentage points to 2.8%, which outside of the COVID year would mark the weakest growth in since 2019. So that said, recession fears, especially in the US, have eased recently as there are signs of potential trade agreements being negotiated. Then moving to the global market overview, in the first half of 2025, markets responded to a mix of cooling inflation, shifting monetary policies, and ongoing geopolitical political tensions. So when we look at the performance of key asset classes, gold stood out as the best performer, outperforming Bitcoin, world equities, EM currencies, EM bonds, general commodities, the S&P 500, and US bonds. So investors moved toward gold as a safe haven, especially amid global uncertainty and cautious central banks. So overall, market direction in the first half was shaped less by strong fundamentals and more by investors trying to navigate shifting global risk and policy signals. Then diving deeper to global equities, in global equity markets, performance was mixed in the first half of 2025. However, in many cases, returns were higher when measured in US dollars than in local currencies. And this is a concept known as dollar measured returns. And this refers to investment gains after converting local performance into US dollars. So this trend reflects renewed capital inflows into emerging markets as global monetary concerns began to ease. And then, as you can see on our screen, Ghana led the pack, driven by strong reforms, falling debt levels, solid GDP growth, rising gold prices, and strong corporate earnings. Then Morocco benefited from stable growth and innovation, including a planned derivatives rollout. So while African equities remain attractively priced, they still face risk from policy shifts and external shocks. Then, as we look ahead to the second half of 2025, several risks are likely to keep global uncertainty elevated. We noted a rise in the Global Economic Policy Uncertainty Index, and this index is a measure that tracks how uncertain or unpredictable economic policy is across the world. So it gives us a sense of how unsure businesses, investors, and policymakers are about economic decisions that could affect things like trade, taxes, regulation, and government spending. So this rise in global economic policy uncertainty index just shows that businesses and investors are still navigating a lot of unpredictability. So from trade policies to elections and regulation, there's a lot that could tilt the macro picture. So as we look ahead, geopolitics, technology, and climate-related issues are expected to play a major role in shaping market behavior. At the same time, the US-China trade dispute is resurfacing, especially around tech, which could disrupt global supply chains and weigh on investor sentiment. We are also seeing the impact of AI disruption, which has driven strong tech gains, but also raises regulatory and valuation risk. So against this backdrop, markets are likely to remain cautious, with investors leaning towards safe havens like gold, defensive stocks, defensive sectors, and countries with stable policy environments. Then for the key global trends, that's inflation, interest rates, and global growth, inflation is likely to keep easing, helped by improving supply chains and lower energy prices. Then on the interest rate front, policy is expected to stay mostly cautious. So some central banks may cut rates to support growth, but persistent global risk will limit aggressive easing. Then finally, global growth may stay subdued with trade tensions and weak demand weighing on momentum. So that said, a sharp downturn seems unlikely unless we see major new shocks. So to conclude, while there are still risks to watch, the outlook for second half of 2025 remains broadly positive. So yeah, that brings me to the end of my presentation. Thank you for your attention.
Awesome presentation. Thank you very much, Ibukunluwa. Like what you said, we're expecting a lot of volatility in the global market. That means there's a lot of opportunities. At the same time, risks abound. Therefore, we tread carefully. But I like as you ended on a positive note, the opportunities to watch out for. Very quickly, we'll move to the domestic markets where the domestic economy, pardon me, where Governor is already here to take us through expectations and guidance for H2. So I'm over to you, Governor. Good morning.
Good morning, Shegun. Thank you very much for the introduction. So at the beginning of 2025, we made some bold calls on the expected performance of some key macroeconomic variables like GDP growth, inflation rates, exchange rates, and NPR, tax reform bills, and FG's fiscal deficit. Now, at the halfway point of the year, it's time to assess the performance of some of our projections. Starting with GDP growth, we projected that GDP would grow at a rate of 3.3% for the year, but we cannot assess this yet because the NBS missed its release timeline for the Q1 GDP reports, and that report was meant to reflect the impact of the rebasing that happened and the addition of 8 new activity sectors. Moving on to the inflation rate, our projection was 24.7%. Currently, we see inflation at an average of 23.7% for 2025. Post-rebasing in January, the inflation reading was 24.5%, and we have seen that moderate gradually to 23% in May. For exchange rates, we projected 1,000 Naira to trade at 1,804 Naira to the dollar, and currently Naira is trading at around 1,551 Naira to the dollar. We note a number of CBN interventions that have helped the stability of the Naira. For the NPR, our projection was a hold stance in H1 and a modest cut in H2. Truly, in line with our expectations, the CBN held rates steady throughout H1 at 27.5%. Now, for tax reform bills, also our projection was the bills were going to be passed in 2025. Also, in line with our projections, just recently, the president signed the harmonized tax bills into law. And what we have seen is the consolidation of all revenue generating agencies into one body, which is now called the Nigeria Revenue Service. And finally, in terms of fiscal deficits, our projection was the fiscal deficit was going to be surpassed by around 73%. Truly, in line with our expectations, it looks like it's going to surpass it for the full year. And in H1, we saw that FG taps into the debt market to the tune of 11.4 trillion. Notably, around 70% of the total debt issued in H1 2025 was used to roll over maturing instruments. So what we are seeing is it has given the government just 3.4 trillion naira in terms of fiscal flexibility and to fund budget shortfalls. Moving on. And still on the topic of budget deficits and fiscal deficits, for last year, we saw that the budget deficit widened, or the fiscal deficit widened, so to speak, despite a twofold rise in gross revenue. Last year, we saw the government's revenue figures grew substantially, The gross federally collected revenue grew at about 126% for the year to 34.7 trillion naira. The net federally collected revenue also mirrored that trend. It grew at around 124% for the year to 28.6 trillion naira. And then the revenue available for the FG's budget grew also by around 57% to 9.4 trillion naira. You attribute the growth in revenue to the impact of the PMS and FX liberalization policies that we saw last year, alongside the full adoption of electronic filings of tax returns. But worryingly, despite the twofold growth in revenue, we saw that expenditures outpaced this. And the main reason why expenditure outpaced this is because a huge portion of the expenditure was spent on debt servicing. Last year, around 11 trillion out of the total 24.9 trillion was used to service debt. Although our debt service to revenue ratio moderated in 2024 to around 116% from 142%, the levels still remain very elevated and is still a cause for concern for the federal government. Against the backdrop also, we saw that the FG taps from the debt market last year around 46 trillion naira. What this means is we have seen our total debt stock shoot up once again. It shot up by around 52.7% last year to over 133 trillion naira. Our debt levels remain substantially elevated and still remain a cause for concern. Moving on.
Okay. 1 second, Governor. So I want to use this opportunity to crave the indulgence of our participants that you can share your questions with us via the chat box. So we are going to attend to these questions towards the end of the presentation. So I thought to repeat that announcement. Thank you very much. We'll head back to the presentation shortly. So once again, thank you for your time. Just to reiterate, the Q&A, please feel free to ask your questions or make inquiries using the chat box. We're going to take them towards the end of the presentation. So we'll continue with the presentation now. Thank you, Governor, and please you may continue.
All right, thank you very much, Shegun. Now, moving on to 2025, we have seen this year's budget, and it's important to note that it was anchored on very ambitious projections, particularly on the revenue leg. But before I go into the revenue leg, let's talk about the non-revenue budget assumptions. First is GDP growth. It was passed at 4.6%. Like I earlier mentioned, we do not have a way to assess this yet because we are still awaiting the Q1 GDP report. The second was inflation at 15.8%. We can see that the current inflation rate of 23.7% is still some way off the budget's assumption of 15.8%. Meanwhile, on the exchange rate front of 1,500 naira to the dollar, we seem to be trading relatively close to that level, and looks like the budget assumption is going to be achieved. Now to the revenue leg of this year's budget. The FG proposed a total of 40.9 trillion naira in revenue for 2025. And out of this, just over 51% of it, which is around 21 trillion, is expected to come from the oil sector. Now, for this 21 trillion naira revenue assumption to be achieved, they set out two benchmarks in the budget. First is oil production at 2.06 million barrels per day and crude price at $75 per barrel. Let's assess so far what we have done in 2025. We have seen that oil production has averaged around 1.67 million barrels per day from January through to May, which is way below the 2 million barrel per day target. And the highest amount of oil produced at any point this year has been 1.74 million barrels per day. Also, on the price front, where the target is $75 per barrel, at least 4 out of the 6 months of 2025, we have seen that oil has traded below the $75 per barrel threshold, which means that at this current pace, the revenue target is not going to be met. For us to be able to meet that revenue target at our current production levels, then oil we need to trade above $100 per barrel for the rest of 2025. And that scenario seems highly unlikely. Currently, our model suggests that if everything remains as is, that means average price trades around this band and oil production too is around this band, then the FG's revenue target is going to be derailed by at least 20%. What this is going to imply is If the FG plans to fully consummate its expenditure plan, then they are going to need to borrow more. In the case where the FG proceeds to borrow more, then we could see our total debt stock shooting beyond 188 trillion naira. What this would imply then would be the debt to GDP ratio will be above 60%, and the IMF currently recommends that debt to GDP ratio should not surpass 55%. Moving on. Despite some of the challenges that we have faced in H1, there have been some silver linings, both on the fiscal side and on the monetary side. On the fiscal side, in terms of credits, in H1, we saw the timely repayment of the $3.4 billion RFI loan secured from the IMF in 2020. Also, we saw recently that Nigeria's credit rating was upgraded by both Fitch Ratings and Moody's Investor Services, both with a stable outlook. The impact of this is Nigeria's creditworthiness status has been improved, and also from the international markets looking in, there's a better perception of our fiscal management strategies. And finally, in terms of silver linings for this fiscal side, we saw trade surplus hit a record high, or the second highest value on record in nominal terms. It hit 5.2 trillion naira in Q1 2025. And the reason for this was a surge in non-oil exports. In terms of monetary silver linings, although the CBN has held rates steady and has maintained a tight approach throughout H1, but their efforts in fulfilling their mandates of both price and exchange rate stability have started to deliver some visible gains. First is the improved FX liquidity, right? Data from the FMDQ OTC platform show that total FX flows for the year grew by 60.2%, and this culminated in a net inflow of $3.3 billion. You'd have to go back more than 5 years for any half-year or full-year period to find a higher net balance. There were some factors that supported this improved liquidity. First is improved market transparency, right? This was brought about by the launch of the EFEMS platform, which is the Electronic Foreign Exchange Matching System platform that the CBN introduced into the market. Also, we have seen better market reflective rates in H1, both on OMO bills, auctions, and other fixed income instruments. And crucially is the establishment of the Nigeria FX Code of Conduct. And that has helped to address both ethical governance concerns, confirmation and settlement process concerns as well. So kudos to the CBN in terms of FX stability. Second one is the exchange rate stability. We have seen relative stability for the exchange rate. If you recall, last year the Naira depreciated by more than 31%, but this year we have seen just a 0.6 depreciation to the current levels. But yeah, this might represent progress. But if we benchmark against our nearest neighbors like Ghana, their currency has appreciated by more than 15% against the US dollar this year. And also, still on the exchange rate front, the parallel markets premium versus the official window that used to create a large arbitrage market in the past, they've also tried to maintain that premium below 30 naira in H1 2025. And finally is gradual disinflation. So since the rebasing of the CPI, we have seen that inflation has gradually trended downwards. And this is thanks in no part to CBN's extended monetary tightening policy, and crucially, system liquidity. System liquidity, it has remained tight throughout H1. If you look at the data on average daily balance that we have seen that we have around 160 billion compared to almost 600 billion in the past. So the CBN has tried to mop up excess liquidity from the financial system. Moving on. In terms of our outlook for this year, we have highlighted a number of factors that we believe will be key to shaping the way 2025 would end. We have both upside factors and downside factors. Starting from the first, which is the global trade and monetary policy dynamics. We expect that the global geopolitical environment will still remain tense in H2 2025, and the impact of this will be a negative one on global trade volume and disinflation. You know, when tensions are still high, things like energy costs tend to stay elevated, and that would just help to keep inflation stubborn. So that means central banks around the world might not be incentivized to cut rates. What this would imply for the Nigerian markets is there will be a slow recovery of foreign capital flows to Nigeria. Next is insecurity in food baskets. Recently, we have seen a lot of deaths in agrarian communities, key agrarian communities, right? Farmers, residents in those communities. Also, we are coupling this with the persistent oil theft and vandalism. These are situations that could possibly worsen the standard of living crisis in H2 for Nigerians. And then, in terms of negative, the rollback on the forbearance regimes. So the view on this is a little bit divergent, so to say, because in the short term, it might be a negative, but in long term, we believe it should be a positive catalyst. Uh, Recently, the CBN released a directive that banks under the forbearance regime should suspend the payment of dividends or bonuses and suspend any investments in foreign subsidiaries. The impact of this will be that the industry asset quality metric, which is NPL, the non-performing loans, will deteriorate in the short term. And then the valuation for the banking sector might likely see a pullback because investors will start to price in the risk, the higher risk, and the possible lower profitability. But to counteract the effect of this, a lot of the banks have made substantial progress in terms of capital raise efforts. So in the long term, this could be a positive for the banking sector. Now, moving on to the upside risk for 2025. First is Dangote fuel supply revolution, right? The group announced recently that they're going to deploy 4,000 CNG tankers that will aid the distribution of PMS and diesel. This also with this in tandem with the recently reinstated Naira for crude deal, we believe would help the availability or the continued availability of fuel supply, and then we could see a possible crash in fuel prices in H2 2025. Now, on the monetary policy front and exchange rates, our view is if there are no major shocks, then the CBN has room to cut rates by up to 150 basis points in H2 2025, because you see there's less attractive rates in advanced markets and the gradual disinflation that we have been experiencing. So we believe this will give the CBN a little headroom to cut rates. Then for the exchange rate, we have reassessed the current environment and also revised our forecast. So we revised our forecast to 1,577 naira against the 1,804 naira that we had previously. This revision was largely underpinned by our robust FX reserves, right? We have seen that FX reserves have grown in 2025. Also, the CBN has tried to eliminate inefficiency in terms of the FX market. And I'll conclude on this slide, which talks about our crystal ball for H2 2025, the factors that we believe could possibly shape how Nigeria would finish 2025, right? And then our projections, either we are revising them or we are keeping them unchanged. Our GDP projection remains unchanged because we do not have sufficient data yet. Our inflation projection also remains unchanged. The reason being is post-rebasing in January, we saw that about 10.3 percentage points was wiped off the headline rate. And we believe that by December, our model suggests to us that we're expecting at least a 12 percentage point spike in headline inflation due to the low base year effects. So we think these factors will kind of balance each other out, and then we have retained our inflation projection. And like the official exchange rate already mentioned earlier, that we revised that, we have reassessed it and revised it to 1,577 naira to a dollar. And finally is FG's borrowing. Our initial projection was 15.9 trillion for the year. We have revised that upwards to 17.2 trillion naira for the full year 2025. The reason for this is we saw the trend of borrowing in H1, right? The FG borrowed around 11 trillion in H1, and there's already a planned external borrowing of $1.23 billion in H2, coupled with the below average crude production level. So we just believe that we have enough factors to see the FG borrow more in H2 2025. But for Nigeria to finish strongly in 2025, we believe that if the revenue collection process is enhanced and then we sustain the little gains we have seen in terms of disinflation and FX stability, then Nigeria can enjoy a modestly strong finish to 2025. On that note, I bring my domestic macroeconomic presentation to an end. Thank you.
All right, thank you very much for that presentation, Governor. But before we let you go, very quickly, could you please shed more light on the how you expect the revenue, the oil market dynamics and all of the production hiccups we have been seeing historically? How you expect the interplay between production, oil price dynamics to play out for FD revenue in 2024? That has been a crucial point of discussion recently. So just a quick one before we let you go.
All right, thank you very much, Egun. In terms of production and price dynamics that we see in 2025, we see because of the global tensions that are lurking, so to speak, there's a possibility of oil prices rising in the second half of the year, which would obviously mean increased revenue for 2025. But our model, like we can see on the screen, it shows that the optimal level, which is the 21 trillion naira level, will not be achieved if we don't get to 2.06 million barrels per day. And at the current rate, that seems unlikely. But in terms of oil price, yeah, there's room for upside. We can see oil possibly trade between $72 to $75 band for the rest of the year. But in terms of projection for production, I really don't see us surpassing 1.8 million barrels 1.8 million barrels per day. So in terms of oil total revenue, you should be looking at 9 trillion naira in full year revenue if oil indeed trades around the $72 to $75 per barrel band.
Awesome. Thank you very much. I can see on the slide, you're saying that crude oil needs to trade above $100 per barrel in H2 for us to remain to cover for shortfall based on the events in H1. But like you said, whether it's a feeble start close 2025 or a strong close rather, it remains to see. But thank you for that awesome presentation. So we're going to be moving very quickly now to the domestic market. As I'm inviting the next speaker, I just want to thank the participant again. Thank you so much for your time, and we're already halfway through the presentation. Also, remember to drop your questions in the chat box. We'll be happy to receive them. So let me bring on Ikeolu Wadibowale. I know a lot of investors are asking, do we buy, do we hold, do we sell? Where will the money be in H2? And Ikeoluwa is there to answer our questions. So good morning, Ike. Over to you.
Good morning, everyone. I'll be taking the equity section of today's presentation, and at the end of my session, I'll be sharing our outlook for the equities market for the second half of this year. So in the first half of 2025, the African equities market stood out as the top performing region among all the markets under our coverage. And they did this by delivering an impressive average return of 16%. And the strong growth was driven by gains, notably in Ghana, Morocco, and Kenya. And this was supported by improved macroeconomic stability, easing inflation, and robust investor sentiment. So in comparison, the BRICS region recorded a solid return of 13.2%. And this was largely driven by India's economic resilience and a rebound in commodity prices in Brazil and Russia. However, their overall performance was tempered by ongoing structural and geopolitical concerns in China and Russia. So looking closely at the SSA market, Ghana posted a robust year-to-date return of 27.8%. And this positioned it as one of the best performing frontier markets in Africa. So the rally was underpinned by a resurgence in investor confidence following the successful completion of Ghana's domestic and external debt restructuring. And this reduced the government's fiscal pressures and also reopened access to global financing lines. Similarly, in Nairobi, they recorded an impressive 19.2% gain in the same period, and it was fueled by improving macroeconomic fundamentals. So moving on to the domestic equity market, the NGX All-Share Index advanced by 16.6% in the first half of this year. And this marked a notable deceleration from the 33.8% rally that was recorded last year in the first half of last year. So in the first quarter, market activity was largely muted as investors shifted towards fixed income instruments, and this was due to the compelling yields we saw in the context of tight monetary policy and also the persistently high interest rates that we've been seeing. So in the second quarter of this year, market momentum strengthened, and it was driven by solid corporate earnings, fairly stable exchange rates, easing inflation, and also the renewed investors' interest. So moving on, the Nigerian equity market started this year with strong momentum, and this was fueled by portfolio repositioning and sizable capital raises by tier 1 banks such as Zenith Bank and GTCO. Also, for our trading activity in volume and value, it peaked in March, and this was spurred by robust full year 2024 earnings results. However, at the start of the second quarter, market activity softened, but as the quarter progressed, sentiment improved, and this was supported by strengthening macroeconomic fundamentals, solid Q1 earnings releases, strategic corporate actions also. So while intermittent profit-taking and policy uncertainty occasionally dampened investors' sentiment, the overall performance in the first half of this year reflected growing investor confidence and underlying corporate resilience in the equities market. And we believe that this has laid the groundwork for a potentially more vibrant second half of the year. So between January and May this year, the total market transactions surged to 3.4 trillion naira. And this is a sizable increase from the 2.2 trillion naira that was recorded in this same period last year. So while domestic investors continue to dominate the activity on the equities market, their share declined to 70.8% from 79.6% that was recorded last year. While in contrast, our foreign portfolio investor participation rose significantly to 25.7%, and it was up from 20.4% that was recorded in the first 5 months of last year. So this resurgence in foreign interest was largely driven by improving foreign exchange stability as global uncertainties pushed investors towards attractive valuations in emerging markets like Nigeria. Next up, we have our sector performance. And as we can see, it was mixed as 4 indices were positive while the other 2 were negative. So to start with, the consumer goods was the top performer, followed by the Afri ICT index, which gained 31.8%. Then we have the banking index and the industrial goods index. On the other hand, we have the insurance and the oil and gas indices, which declined 11.5% and 9.4% respectively. So for outperforming stocks and underperforming stocks for the first half of this year, for the outperformers, we have Better Glass, Smurfit, Honeyflower, Vitafoam, and some others. While for the underperformers, we have Julius Berger, John Holt, Deep Cap, Cornell, and so on, as we can see on this slide. So moving on to our comparison of Nigeria's equities markets with some selected peers. Despite a sharp 91% increase in our earnings per share as of the first half of this year, the NGX ASI's price to earnings ratio declined from 10.26 times to 6.56 times. And this reflects a significant valuation compression that was driven by stronger corporate earnings and a more cautious investor stance amid the persistent macroeconomic uncertainties in the country. For major corporate actions, we saw the listing of Nigeria's first tech company, that is Legend Internet PLC, as well as the share buyback from Tolaram Group. And we also saw an acquisition in the oil and gas sector and the listing of a couple of companies across different sectors, such as Medview Airline, MRS Oil, and Gold Link Insurance. So the reason these companies, these stocks got delisted is because they did not comply with NGX's post-listing requirements. So moving on to the banking sector, Tier 1 banks like Zenith and Access have successfully met their recapitalization targets as of now. But some others like FBN, UBA, and so on are still in active fundraising mode ahead of the 2026 deadline. Banks like GTCO and First Bank, they have made significant progress, and they still have ongoing phases of fundraising currently. For instance, First Bank's rights issue brought in about 150 billion naira, and they are currently in a 350 billion naira private placement phase. For GTCO, they raised about 209 billion naira in the first round of issuances, and they are currently planning further phases. For UBA, they completed a rights issue that raised about 251 billion. And coupled with their capital base, they have about 355 billion naira already. So they will only need about 145 billion naira more to go. But this gap is expected to be closed very soon. So for the remaining banks, they plan to raise funds via different processes like private placement, rights issue, or public offering. So for now, I'll be sharing our outlook for some key sectors, starting with the agri sector. So for the agri sector, we expect that the growth in the second half of this year is going to be supported by higher food demand and ongoing government input interventions. So particularly the oil palm sector should benefit from strong CPO prices, better weather, and resilient operations. However, some key downside risks here are inflation and insecurity. For industrial goods, government-led infrastructure spending and increased industry capacity are expected to drive growth in the second half of this year. Also, improving inflation rates and a better and more stability for our exchange rate should also support profit margin expansion, despite the headwinds from flooding and regulatory pressure to cap cement prices. For oil and gas, we anticipate some foreign direct investments in this sector, and this should also be supported by strong capital expenditure from key operators. And we believe that the sector is poised for a buoyant performance for the rest of this year. For the banking sector, the outlook remains broadly positive, and this is underpinned by expected earnings growth and the ongoing balance sheet optimization. And for the second half of this year, we anticipate further momentum as banks accelerate their recapitalization efforts towards the 2026 deadline. And we believe that this should improve investor sentiment, particularly within a more stable regulatory landscape. So for consumer goods, given the evolving macroeconomic landscape with FX stability and lower inflationary pressures, we believe it should translate to an overall positive full-year bottom line for this industry. And we hold a cautiously optimistic outlook for the consumer goods sector. For telecommunications, our outlook is cautiously optimistic also, and this is supported by the impact of tariff adjustments and fintech expansion, as well as growing data demand. And this should translate to revenue growth and margin recovery, which is backed by cost optimization. However, some downside risks for this sector remain should stem from FX instability, high cost of capital, security disruptions, and also some regulatory inertia. For the power sector, we believe this sector is poised for moderate growth, and this is driven by ongoing policy shifts and rising private sector interest. So while structural inefficiencies and liquidity constraints will persist, key opportunities lie in decentralized energy and also the renewable energy space. And finally, for insurance, There are currently there's the recapitalization process that is ongoing, and we expect that this will unlock a new phase of growth, consolidation, and market deepening. So for this, we hold a positive outlook, and we expect that this sector is set to be more resilient and competitive in the days ahead. And it's going to be driven by increased product innovation, deeper insurance penetration in Nigeria, and also enhanced regulatory oversight. So generally for the equities market, our outlook is positive, and we have retained our projection for the full year 2025 at 30.4%. And this is because there isn't much difference between the current market dynamics and our initial forecast at the beginning of the year, which was premised on some key factors, such as the banking sector recapitalization continuing at the same pace, moderate earnings growth in core sectors, fairly stable exchange rate markets, the CBN holding rates till the fourth quarter of this year, a major listing on the NGX, and finally, fixed income yield moderating in the second half of the year. So this brings me to the end of my session. Thank you very much for listening.
Awesome. Thank you very much for that. A very interesting presentation, Ikeoluwa. And one thing that caught my attention was when you mentioned that when you look at the performance of the Nigerian market on an annualized basis, that's in H1, it's very much spot on with our start of year projection for the equities market. That means if you have followed our investment analysis and advice, well, you should be in the green at the moment. Well, but not to worry, there are a lot of opportunities ahead. We'll move to the fixed income session where we're going to explore some of those opportunities now. And Prosper Olushola is just here to help us do that. Good morning, Prosper.
Hi, Shegun. Good morning. Good morning, everyone, once again. I'll walk us through the fixed income segment of this presentation, looking at how the market fared within the past 6 months, globally and domestically, as well as what lies ahead in the second half of the year. Now, to start with, spotlighting the global fixed income space. In the first half of the year, we see that global debt rose by $6 trillion, but also debt to GDP stayed stable. Now, in the advanced economy, yields remained flat as central banks leaned into monetary easing. And we see that this easing, especially in the sub-Saharan African space, it supported a strong rebound in emerging market currencies despite lingering tariff risk. Now, moving on, we see the emerging bonds rally in the first half of 2025. And this rally was underpinned by dovish policy shifts from major central banks. And as such, this also boosted carry trade flows into emerging markets from the advanced economies. And this also was a positive performance for the emerging market bonds as it rebounded and it outperformed US Treasuries. Now, on the next slides, in the sub-Saharan Africa Eurobonds and corporate Eurobonds market, we see that performance was bearish. And this performance was skewed by the global geopolitical dynamics. As such, average yields rose 60 bips and 20 bips to 8.6% and 7.4% respectively in the period under review, which is for the first half of 2025. So the prospect of more dovish monetary policy decisions in the advanced economies could influence investors' decision in the remaining half of the year. Now, on the next slide, moving on. The table above, it tells a story of the diverse economic landscapes across Africa and how they're shaping the African corporate Eurobond space. We see that while some have high inflation and interest rates, these are common themes in some of the countries. Others are demonstrating resilience and also positive shifts. Now, spotlighting Nigeria with foreign reserves of around $38.4 billion, and is also managing high inflation, although it's been rebased, and we see a steep interest rate of 27.5%. While we anticipate a potential rate cut in the second quarter of 2025, which may offer some relief, the Naira, however, has weakened year to date. And looking at some of the key drivers that has influenced this Nigeria's Eurobond space, looking at the outlook that could shape this space is the interplay of credit rating improvements, oil price trends, and a continued energy sector reforms. Now, let's shift our focus to the domestic fixed income space. The Nigerian debt market also remained under pressure. And in the first half of the year, the APEC Bank maintained monetary policy rates at 27.5%, amid persistent inflation and FX volatility. As such, we see that there was a tight system liquidity conditions, and this kept interbank rates and also NTB yields elevated. While we see that real returns remained mostly negative, despite the inflation rebasing. Now, moving into the primary market auction space, we see that stop rates held steady, and it just reflected cautious investor sentiment. Overall, yields are expected to remain firm unless there are notable improvements in inflation or system liquidity. Now, moving on, I'm looking at federal government borrowings. Taking a look at the federal government borrowings in the first half of the year, we see that the federal government raised 11.4 trillion naira domestically. And this debt funding was heavily tilted towards short-term instruments, majorly the NTBs, which accounted to 8.5 trillion naira of the total amount raised, while the FGM bonds accounted for the rest of the amount raised. And this just shows a focus on immediate liquidity. However, it still falls short of the projected estimate budget deficit of around 14.1 trillion naira. And comparing vis-a-vis our own estimate of 17.2 trillion naira. And this just shows it goes on to show that there's a significant funding gap in this space. Now, moving on the next slide, we see that most bond allotments were front-loaded in the first quarter of 2025. And by the second quarter, we began to see activity declining. As such, we see that marginal rate showed slight moderation. But the funding mix goes on to suggest that the need for more medium to long-term issuance or external funding if we see that our FX inflows underperform. Now, what this just shows is that short-term borrowings is liquidity needs, but it raises major concerns like rollover and yield risks heading into the second half of the year. Now, when we try to compare the performance of the NTBs vis-a-vis the federal government bonds for the first half of the year, we see that the NTBs average yield still outperformed averages on the bonds, as although it declined for the NTBs, it declined with around 581 bips to steady at 20.2%, and comparing it to the averages on bonds, which closed at 18.4% for the first quarter of the year, we still see that the TLB still offer the yield premium despite it declining. Now, as I earlier mentioned, that MPR was held steady at 27.5%, and this just helps to stabilize long-term yields. Although we see that the yield curve still stayed inverted, albeit it was marginal, and just helps narrow the ongoing short-term risk inversion. As I mentioned, also looking at how the exchange rates was volatile. We also see system liquidity being volatile. Despite all of this, the sovereign bond posted a strong rebound with 12.2% returns for the first half of the year. And this just shows that investors remain cautious, and it favored their appetite tilting towards short-term instruments amid inflation and liquidity risk, even as we see that the yield curve begins to show signs of normalizing. Now, on the next slide, moving on, in the period under review, looking at commercial papers as well as corporate bonds, we see that the number of issuances and the amounts raised for commercial papers and corporate bonds declined. For issuances, it declined 7.9% and 75% respectively, while amount raised dipped by 46.2% for commercial papers. Now, looking at the federal government's fiscal pressures heading into the second half of the year, we see that the federal government still faces mounting fiscal pressure heading into H2 2025. Despite their 13.3 trillion naira in gross domestic inflows during the first half of the year, which was mainly from NT bills and OMO sales, this impact was neutralized by coupon and maturity obligations, resulting in no net funding at all. And then looking at our full year projection of deficit of 17.2 trillion naira, which is well above the official 14.1 trillion naira estimate, which just shows that it's creating a projected domestic funding gap of over 10 trillion naira in the second half of the year, as we see that domestic borrowings for the first half of the year was approximately 3.4 trillion naira. And even with optimistic projections of 13.6 trillion naira in additional borrowing and 1.6 trillion naira from other sources, there still remains a significant shortfall in funding gaps. And this just shows that Nigeria financing needs remains high. And without stronger revenue inflows or spending adjustments, further borrowing or concessional fundings will be critical to closing this significant gap. Now, moving on, as I conclude, we look at our outlook for the fixed income market and moving into the second half of the year. I believe that there are three main factors that will shape this space: inflation, interest rates, and federal government borrowings. On an inflation front, while we see that inflation has been rebased recently, although it's still elevated, so we expect that for the year 2025 full year, it should average 24.7%, and this is supported by expected disinflation that we believe coming by the second quarter of this year. Moving on to interest rate, the monetary policy rate is projected to remain elevated at 27.5% through the third quarter of the year. And then by the fourth quarter of 2025, we expect to begin to see like a mild easing between 100 to 150 bips coming in possibly by the fourth quarter of the year. And this is if inflation cools as we expect it to. Although currently we see that policy still remains neutral, and also, but we are optimistic that there will be significant tilt towards easing. And lastly, looking at federal government borrowing, the federal government is now projected to borrow 17.2 trillion naira net in 2025, up from the early projection of 13.7 trillion naira. And what this just shows that it implies an additional 6.4 trillion naira gap that needs to be met, which will need to be raised by the second half of the year. And this could keep supply pressure high in the market. So by and large, yield direction for the second quarter of the year will be shaped by how inflation moderates, how the Central Bank of Nigeria reacts, and how much the federal government needs to borrow. And if this stabilizes, we may see some relief in the fixed income markets by the fourth quarter of 2025. And with that said, this brings me to the end of my presentation for the fixed income section. Segun, over to you. Thank you.
Awesome. Thank you so much for that wonderful presentation, Prosper. Like you said, the outlook for the market is cautiously optimistic, even though we are seeing on one side where debt build up, but on the other side, we're expecting that interest rate environment might begin to cool off as we proceed into the year. So thank you so much for that presentation. And ladies and gentlemen, also I want to thank you for your time. We're keeping to time and we're still on track. But it's not just enough to hear about all of these opportunities and not take action. Action is gold. Action is everything. So as a reminder, Afrinvest, we have for 3 decades been in this business of simplifying investment and creating wealth across our business verticals, whether it's brokerage solution, whether it's securities, whether it's capital raising, whether it's research solution that our consulting services or trust, or whether you're looking at create retail-based solution for savings, which we provide through our different Andromeda technology. That's the Optimus product. We serve customers' need, and we are open to guiding you through the second half of the year, helping you in specific ways to execute, because it's one thing to know where the opportunities are, and then another to know how to execute, how to enter. And I can see in the comments section, we're having very good and very interesting questions on how do I take advantage of these opportunities, how do I trade in this market and the other market, and my colleagues have been providing answers. However, our emails are still open if you have questions that during the course of presentation we somehow missed. Apologies for that. You can still reach us via brokerage@afrinvest.com or research@afrinvest.com. So I will take it again: brokerage team at afrinvest.com or research at afrinvest.com. Also, we have a lot of funds in the market, whether you're looking for equities or bond, both in dollar and naira, or you're looking at maybe the NIDF infrastructure fund. And also, very recently, we launched our Afrinvest Halal product, and I can assure you that caters to every need you can think of. If you're someone that you're aligned with the principles underlying that investment. And so we are very open for business. We are especially open to guide you through the second half of the year and even beyond. So I want to thank you again, ladies and gentlemen, for your time. It's been a pleasure having you here, and to respect your time and to keep with it. We are going to draw the curtains here on the webinar, but our doors are very much open. We look forward to your emails. We look forward to seeing you walk into our offices and helping you grow your investments. Thank you very much, and do have a pleasant second half of the year. Take care.